Yeah. So these are the liquidity risk issues, and now let's see operational risk, because there is most of the strange things happen. So we can find here anomalies at least. So we can see that once we are processing this, we are around the end of the, or around the 600 pages, because practically operational risk is before liquidity risk, but I wanted to go in a different direction. So operational risk. In this case, we can say that the book starts to point on many things like developing new products, big rogue, rogue, yes. Yeah, rough is not the other thing. And so a big rogue trader loss, cyber risk, violating economic sanctions, entering new markets, money laundering, and all the other things. So practically all the risk of mistakes in processing transactions, making payments, or practically this is a residual risk. When we have some revenues, and after that taking out the impact on credit losses, profit or losses on market risk exposure, and what remains at the end of the day is operational risk, and it can create a variation in the income. The problem is that if we have credit or market risk, at least we have some kind of traded instruments to deal with this. Also, the book mentions that we can have an insurance against some of these cases. Okay, not against new product development or crazy traders, but at least against cyber risk, since they are appearing nearly randomly, then we can, after a nice audit, we can buy insurance. Entering new market, yeah, this is classical business risk. So it relates to operations. Violating economic sanctions and laundering money, we can say that this is also part of the operations. So I'm talking about or thinking about Credit Suisse or Deutsche Bank. Still, Deutsche Bank still exists. It's a miracle that after all these punishments coming from the US, coming from the ECB, after all of their dubious actions, still they can operate. So they are really efficient washing machine. Okay. So we can say that operational risk is a necessary part of doing business. I'm not talking about money laundering, but the problem is that it's much more difficult to quantify. So how can we delegate or allocate capital to cover this? Sometimes it's not even recognized as a risk. Practically, operational risk is defined only since 2001. Since Basel Committee said that okay, it will be included in Basel II, still banks hated this, and I can understand why, but yeah. So they have to identify all the types of the risk, what can be taken, and how should be insured against. But again, so dealing with operational risk is much more about business procedures. So if you can define well the procedures, the guidelines, you can calibrate well your whole computing system and IT stuff, well, then practically this is good for the bank. So the Basel Committee created this nice definition for operational risk. Risk of loss resulting from inadequate or failed internal processes, people and systems from external events. And we can ask the question that, okay, but if we are talking about ESG scoring, then the G, the governance, can be related to operational risk levels or not. I have no idea. That right now we are running an analysis which is still far-fetched amongst European banks, so we downloaded all the data from all European banks which are publicly traded, or their ESG scores, their other financial data, but But it can be a really interesting thing that the G, the governance component, how it's related to the operational risk, because it's supposed to. If
Parts of it, maybe. Not the whole index, maybe.
yes, yeah, or if it would be much better if it's not the part, but if there is a causal relationship between them. So if operational risk is high, then the G is low. So yeah, this will be my homework for the summer to see that how these things are coming up, because right now what we can see that once banks realize that they can get money through ESG scoring, some banks, not all of them, but some banks started to improve their ESGs. And also their P/E ratios were developing at the same time. So they realized that maybe we can sell our shares at higher prices. So so let's use this thing up. So that's why it would be interesting to see that is this a bubble again, or G washing? Stranger than I was expecting.
I think some of the papers actually found a reverse relationship
Yeah.
for ESG performance and profits.
Yeah.
So it's not really a clear cut.
Yeah. Yeah, but if we are focusing on risk,
I think in this case it's pretty narrow, so
Yes.
it's possible to find it.
yeah. So we will dig in this direction with the crew, and obviously this thing is not including reputational risk, because it would be impossible to manage or quantify, a risk from strategic decisions. Still, come on, it's for the management, that's why we are keeping them. But still we can define internal and external risk. So internal risk, which are coming from our employment, that they are doing wrong things, computer system, because they can be hacked, controls, because they are inefficient. So at least internal risk, the company has an influence on this. The external risks are coming from natural disaster, political risk, regulatory risk, security breaches. But security breaches also, okay. So at least the first 3 points we can understand that. But this is also a classic economic and political risk assessment scenario. But we were also learning at international financial management when we have these different scoreboards and so on. Okay, categorization of operational risk. So the book defines many different categories, and I try to summarize everything in one slide. So we can have internal fraud, so misappropriate, property usage, stealing, circumventing regulations, it will be good in this way, what can possibly go wrong, approaches, or not obeying the law or the company policy. But if we are not obeying the company policy and still we can do it, it means that the procedures are bad. So we have non-efficient controls, and this is how Sarbanes-Oxley Act was also trying to solve this, that okay, you can do it, just in this case the high management will go to the jail, which is, I can live with that. So misreporting of positions, employee theft, insider trading, or rogue trading. External fraud, obviously robbery, forgery, check kitting. What is check kitting? Check forgery, I think. Forgery, when you are just making up checks in name of clients or in name of the bank, or because in Europe we are not using checks, which is the Anglo-Saxon and Japanese thing, I think. Computer hacking, it's coming from usually from outside, but usually sometimes you need inside their people.
Checks with no funds. Writing checks on non-existent funds.
It's an Anglo-Saxon thing, I think, because it's not at least not on continental Europe. Luckily, we don't have this. I would hate it that someone just give me a paper with some numbers on it and I should go to the bank to cash it. It's so medieval.
Checks with no provisions.
Yes. Yeah.
I'm translating it
Yes.
On French.
Yes.
But yeah, I think this one is a British one.
Yeah. Employment practices and workspace safety. So, yeah, when windows are falling toward employed people. Health and safety laws and agreements. The safety culture, risk culture. I know that when BP had this small oil spill in the Mexican Bay more than a decade ago, nowadays they had to reinforce their security culture. So even new workforce had to promise that when they are walking down the stairs, they are using the railings. So they had to increase their risk consciousness until these levels. But obviously, this risk consciousness was removed by COVID again, because yeah, now they are walking down freely on the stairs, because at home office they lost this internal desire to use the hand railings. Execution, delivery, and process management level. So transaction processing, process management, disputes with trade counterparties and vendors, data entry errors, collateral management failures, incomplete legal documentation, unapproved access to clients' accounts. Mostly this is absolutely general. So for any companies, if they have these issues, then this is not a bank. Practically none of this bank-specific issue. Okay, the check kitting, but also if you are... there was this scandal several years ago when fraudulent entities called upper managers in Hungary and in other Central and Eastern European subsidiaries and asked for money because they were impersonating other subsidiaries, and they were able to get money. So there was a level of trust inside the multinational companies that they started to transfer monies in a nice way. So you can find some articles or papers about it, because at that time it was a huge issue. But data entry error, so people are always saying that, oh, AI will take our jobs, but until not the whole business process, until the last vendor or supplier is digitalized, you are not able to do this, because human errors, data entry errors will be always there, and if you are just allowing the computer to take all the data granted, then we will have really bad times, because the worst thing what I was able to see as an example, when someone was missing or mixing up numbers, and hour and minute was considered as liters of kerosene. So they were processing up the invoices in a bad way, and so this is what you can recognize as a human, but not as a computer. So the computer would allow it. Well, let's pay the date out as money, because this was loaded in the airplane. So no. Clients, products, and business practices. Unintentional and negligent failure to meet the professional obligation to clients, the use of inappropriate products or business practices, so fiduciary breaches. Fiduciary, yes. Fiduciary, yes, you're right. Okay, I'm not using this word so often. This like Fabergasted. I never use this. Just sometimes I can meet with this in YouTube videos.
It looks horrible.
Yeah. It's like an illness, or I don't know. Well, if you have this, you have to go to your dentist, or I don't know. Misuse of confidential customer information. Oh, we can find all the internet. Sorry, all the IT companies, all the e-trade companies, when we can see. Oh, Facebook. They are not trading with our data, just, yes, we are the data. Improper trading activities on the bank's account. Money laundering. Yeah. So, money laundering is always a big problem. So, okay, it's illegal on one hand, but on the other hand, I can understand that there can be huge incentive inside the banking system to make things legal-ish, and you are providing some services. So I think that there is a huge gray territory. What differentiates money transfers, and also we can find money laundering here and there. So maybe willingly or unwillingly. There was this issue when in several US states they legalized the consumption of marijuana and also the sales of marijuana. And the problem was that, okay, shops were able to sell this and someone had to produce it, obviously. So there was the agricultural background and the service background. But at federal level it was still illegal, so they had to run a cash-only business because they were excluded from the banking system, from the financial system. But also at the other hand, reports were saying that this money was still sooner or later moved into the bank because you don't want to sit on cash reserve because burglary will happen or even more vigilante will happen. So in this case, that you are using up the cash to open another entity, and then you are moving through this cash and create artificial revenues, and after that you can put it into the bank. It will be automatically considered as money laundering, even if the money is coming from legal entities or legal activities. So it's damage to physical assets, natural disaster, other events like terrorism, vandalism, earthquakes, not cakes, fires and floods. Business disruption and system failures, hardware and software failures. I hate this one. You are going to a bank and they are saying that, oh, the system is not working, or when you are going to the telephone company, they are saying that, oh, right now we cannot provide you this service because the system is not working. And come on, guys. I mean, in this case, you should sell hamburgers. Oh, the ice cream machine is not working. Okay, the same thing. So, telecommunication problems, utility outages. If you are not able to solve it as a bank, you should not operate as a bank. So even a burger company needs to solve this sometimes. So business lines within the bank, they are defining 8 business lines, which can have all these yellow risks. And oh my God, how does it look like? Okay. Now it looks better. So business life within the bank, so we have to not just identify, but also we have to create procedures to fight with these issues at the level of corporate finance, tradings and sales, retail banking, commercial banking, payment and settlements, agency services, asset management and retail brokerage. So practically we have 1, 2, 3, 4, 5, 6, 7 multiplied by 8. We have 56 points where we can be harmed through operational risk. So good luck to deal with this. Okay, so under Basel II, they try to provide 3 different alternatives to determine operational risk and to delegate and to define regulatory capital under Basel II. So the first thing was that let's have a basic indicator approach. What is the annual gross income, which means that net interest income plus non-interest income from the last 3 years, and after that let's define that, okay, 15% must be covered of this revenue or this income as capital, and this will be enough. But obviously for some banks it was not enough, so this was just for the really small savings banks because everybody tried to reduce the capital requirements. to cut it back. So for the middle banks, they created this standardized approach. So you have 8 business lines, what we mentioned already, and you have designated beta factors. And you can see that, okay, corporate finance is more riskier, trading is still more riskier, but also at the same time, retail banking, it's quite straightforward. So you have just this 12%. Also asset management, retail brokerage, where the fraudulent activities are less probable, so they have just 10%. And after that, you have nicer weights. Or for big banks, you have this advanced measurement approach. And this is when things are starting to go sideways or in exotic directions. So they are trying to create 1 year value at risk operational risk losses. So they have to determine this. For all the 56 combinations of risk types and business lines, and they have to create a capital reserve between the expected loss and the 99% of percentile. And that's why they can use internal data, external data, scenario analysis, and business environment and internal control factors to determine. So practically 1, 2, 3, and 4 model to have this. I can understand why they use this one and that one, but why this one was introduced, I have no idea, because yeah. So they have to determine the loss frequency distribution. So how many times do we have something? Practically they are thinking that this is randomly happening through time. It should randomly happen, because otherwise the whole business would be organized towards such issues. So it would be intentional from the side of the management, so it would be highly management misconduct. In this case, if this is just a whoopsie, then it should be random. So they are generating or using this Poisson distribution to determine this. Loss of severity distribution, distribution of size of loss given that loss occurs, so lost money. And from the two things, so loss frequency, loss severity, they are creating this probability of losses in numbers. And still the problem is that how can you generate this? Because okay, you can say that we can use a Monte Carlo simulation, just you need this data and this data. And banks did not have information, so they were not collecting this kind of data in the past. So when Basel committee was coming up with this in 2001, they started to run around that, oh, we need this. So what was the approach? If you are a big and prudent enough bank with transparent operations, at least you have some data about your high frequency, low severity losses, that someone was mistyping and let's deal with this, or there was some small hacking, maybe we lost some ATMs, we can deal with this one. Or low frequency, high severity losses that, oh, one of our trader went rogue and they lost several billion US dollars, then it's a more expensive whoopsie. Or if you were not so transparent or prudent in the part to record everything in a nice database, then we can have this data consortium. So usually banks were stepping together, or parent banks were selling databases to their subsidiaries. Even I was able to hear that some Hungarian banks, small banks, savings banks, started to purchase databases from Germany, which is stupid because, okay, legislational background is the same, because Hungarian banking regulations are carbon copying the German ones since the 90s. So I cannot say it's literally translated, but the whole approach, the viewpoint of the legislation is the same. So okay, we can do this. Just on the other hand, still business procedures are different. So, but they needed data because they wanted to have the fancy approach. You can buy it also from data vendors, which are using publicly available data at some confidence levels. And estimated loss of a bank will be just normalized from other banks' losses, and we are normalizing it with the difference in the revenues. And there is this alpha number which was just falling from the sky that you can use this. There was no calibration behind it, just the book said that, yeah, this is alpha. Cool. Or you can have scenario analysis. So you have to see that scenario happens every millennium. I have no idea what the legislation was coming up with this thing. Because once in a time you have a row trader, but come on. Even the climate is changing within several hundred years. So. Okay, so these four things can be reasonable. Yeah. So we have at least the different lambda numbers are increasing more and more in these cases, but yeah. So Basel committee realized that they created a huge inconvenience for the banking system. So in March of 2016, they were coming up with this conservative document standardized approach for operational risk, which were saying that, okay, let's remove all these approaches and let's introduce a new one, because banks are banks prefer to introduce new things already. So standardized measurement approach was introduced. Still, a lot of big banks were completely mad because after they were developing this advanced measurement approach and they organized all their business models and collect data, now they should abandon this. So many countries and supervisors, national supervisors, continue to use this and allow this because it's already working. Then we should let them. But at least these other things were replaced, and maybe this will be replaced in the future. Practically, what we introduced the business indicator, which is something like a gross income, but negative income is not reducing this one, and also operating expenses will increase this. So it's a corrected gross income, just with a different name and after some corrections. And in this case, you have this table, which is absolutely not compensated with inflation, and if we can see that the BI is somewhere between billions of euros, then it will generate a BI component in millions of euros because of some kind of optimizations. And you have to determine a loss component. So an average total annual loss from operational risk, an average annual loss bigger than 10 million euros, an average total annual 100 million euros loss, which is quite similar to the previous scenario analysis. Just in this case, you have to say that, okay, from the last 10 years, because already we have the data, so we are in 2016, so they had to collect the data to calibrate their previous approaches. Okay, so what is the loss nature of the company? And after that, they have to take this loss component, divide it with this BI component, which is determined miraculously by Basel committee. And after that, if you are doing the math, it should be around 1 for an average bank. If it's a more riskier or less prudent bank than the average, then this number can go up. Or if they are more prudent, more conservative, then this number can go down. But it was calibrated that for average levels. I think that's why they are using these numbers here, because they had big data, and after that they were able to optimize. Also, we can see that if you are bigger and bigger in BI, so practically if you are increasing the size of the bank, then these numbers will go up. So practically they are trying to fight the too big to fail effect again. And if we have this internal loss multiplier, then practically they can say that, okay, let's grab this BI component take out this number, which is the baseline number here. So let's take the truncated BI value, multiply it with the internal multiplier. If we are fancy, then this number will not increase at all. So we will get back to the original scenario here. If we are more riskier, then obviously this starts to rise and increase, and then things will happen. Yeah, so that was the book, and still we have some nice liquidation task to think about. So there were not so many examples, unfortunately, in the book, numerical examples, but at least we can see that, okay, what happens when we have to face liquidation costs? So suppose that the financial institution has bought a lot of shares in one company and a lot of kilograms in a commodity. Then there is the bid-offer spread for the shares, there is the bid-offer spread for the commodity. So what happens with the mid-market value in shares, commodity, and after that what happens with the proportional, so compensated with the mid-market value, bid-offer spread in the shares and the commodity, and after that cost of liquidity. So, yay! So mid-market value is that we have so we were taking the average, it's 90, then we have to multiply it with the number of things, and also we have to do the same thing, that okay, the average will be this number here, because we average them out, but still we have to compensate it with the million kilograms. And I know it's in freedom unit, but yeah, we are in Europe. And bid-offer spread in shares will be, because it's proportional, so 1 divided with this. It's 1 because this, oh sorry, this minus this one, so it's 1. And this minus this one is 0.1, so this is going down here, this is going down here as well. Yeah, because we don't have to multiply them with, we don't have to scale them up, just we need the ratios. And after that, cost of liquidation at the normal market is that this number multiplied by this number divided by 2, according to the equation. And also we have to do the same thing. At the end of the day, we can see that cost of liquidation in the normal market is 7.5 million. So this is what we are just losing because we are fire selling everything in the procedure. And we can see that, yeah, already the position was around, yeah, this is number of shares. So okay, it's let's say it's 900 million US dollars plus plus a lot. So maybe it's not that significant, but still I will be happy to get this. So what happens if we are in a stressed market? So the mean is $1 and the standard deviation is $2 of the bid-offer spread for the share. So how volatile is this thing? And also we can see that the bid-offer spread of the share is so, yeah, this is the proportional. And also we got the dollar value and the proportional value for the commodity as well. And we are assuming that the spreads are normally distributed, and this 99% is important for us. So practically in this case we have to say that, yeah, 0.5, which is coming from, where are you coming from? Because this is the share. Yeah, because yeah, we have to divide it by 2. Okay, so yeah, after that, this is the expected value, this is the confidence interval, so it's coming from the 99%, and this is coming from the standard deviation, proportional standard deviation. and also here what we have the position in the commodity, and this is what we get again from the proportional thing is, and yeah, in this case the expected value and also the volatility is the same number, because why not? It's defined by the book this way, and after that we can see that, yeah, this is the stressed. So instead of 7.5 million, it's 36.5 million, so we can lose way more on a stressed market. Yeah, and ladies and gentlemen, that was the whole semester. I hope you were able to learn a lot of new things. I try to do my best. We will learn to use MATLAB a lot, and we used mostly I was promising that we will use Excel. Sometimes we use Excel, but we use much more MATLAB because MATLAB is fancy, and also sometimes I try to show you affiliative icons. So yeah, that was all, and